Welcome, everybody, to the quarterly market update, 2023 Jacksonville real estate market update by JWB. I'm your host, Pablo Gonzalez. With me, as always, that guy I like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you.
And with us, as always, is our community manager, Madison, as well, who is manning the chat. If you have any kind of question, if you need any kind of help, pop it in there in the chat. If you have any questions for us, put it in the Q&A. It helps me keep track of this. We usually have, this is our best attended call every single quarter. So we already have 70 plus folks in here. Feel free to make a friend in the chat. You are being joined by JWB clients and also viewers of our weekly program here that we call the Not Your Average Investor Show, that we do live on Tuesdays and Thursdays at 12:30. It's a good time, and welcome. If you are new, let us know. If you are a member of the community, as usual, you know what to do. I don't need to tell you. And Gregg, you always, when we start these things, I feel like there's always this like level of, I don't know, gratitude, responsibility. You always come in here with a different kind of energy about you because you take these real seriously, right?
I mean, we started to do these quarterly calls 2 years ago, 3 years ago, somewhere along the lines. And I just really appreciated the opportunity to sit back, think about the business in totality and how I can relate it to you all out there so that you can make better decisions with your money. And as a part of that, I get to just sit back and think about the amazing opportunity we have to serve you all and the amazing responsibility that we have that comes along with that. We manage over $800 million of your money now when it comes to the real estate portfolios that we manage. There's over 5,400 rental properties that we manage. Those are 5,400 families that we have to provide a wonderful living experience to. And there are thousands and thousands of others that depend on us to make good, sound decisions. And so it's an awesome responsibility, but always want to say thank you all for the trust that you put in our abilities to manage your money. Many of you have never, ever seen your portfolios in Jacksonville. Pablo, you live in Jacksonville, so you've never seen your real estate portfolio in Jacksonville. Yeah. And that's okay. I mean, what we're trying to do is to bring access to this asset class and make it easy for busy professionals to take advantage of this asset class and not be so dependent on stocks and bonds. And so thank you all. We have over 1,600 clients. We've sold over 3,000 properties. As I mentioned, manage over 5,400. And none of that happens without your trust. So super appreciate you spending the time with us today. I hope to bring a tremendous amount of value and help you all make better decisions.
And we know we get new listeners, new watchers for this show every single time because JWB has a famous data flywheel. They are the category kings of Jacksonville real estate investing. So if you are here for the first time, welcome. We're here to report on the status of the local economy, some insider news that JWB, like that Gregg takes very seriously to put together for you. We're going to talk about where we see the market going. And we're also going to talk about the KPIs and the business metrics of JWB. So if you're new, you're in store for some insider information, some really professional advice. And if you come here often, that's because you're a fan of the show, you're part of our community, and I would not be doing you a service if we didn't start with our usual tradition. GC, what's that?
Let's do it, baby.
The roll call. We're going to do a real quick roll call. We got our leadoff hitter leading us off as usual.
John Henning,
of course. We got the MVP of the Not Your Average Investor community.
Mr. Lee Bishop.
We got the touchdown maker.
Miss Shannon Baker.
We got the early bird of the community. Everybody checking in. We got the ringmaster of the community.
Barnhill.
In the house, we got Christopher Lee from Fernandina Beach checking in. We got the second family, our regulars from Marietta, California, Gary and Rosalind Riley. We regard you. We got the shaman from the Pacific Northwest.
Oh, that's Nadine Shaw. I'm sorry. It's just, it was implied.
We got Layla Powell in the house.
JWB team in the house.
We got the patron Santorios of the Not Your Average Investor community.
Michael Santorios. Well done, buddy.
That's a new one. We got Big Papa in the house. We love it when he calls it Big Papa.
When it pops. Hello, how are you? Good to see you, buddy.
Cohen. We got Leo Faraganan.
Dun 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 dun.
Faraganan.
Dun dun dun.
It's been a while since we see you, Leo. Good to have you back, my friend.
Brings him out of the woodworks.
Yeah, we got somebody checking in with a Not Your Average guest. That means you came in from the text. I don't know who you are, so you got to tell me your name so I can call you out. We got the karaoke witness,
Deborah Schwartz.
Schwartz in the house. Victor Scarpula is back as well. Hello, everyone. Alicia Heimbecker.
There we
Check it out,
go.
from Harrisburg, PA.
Longtime client.
That's over by your way, right?
Yeah, close enough. Pittsburgh.
We got Camilo Hidalgo. That's a new name.
New name?
Welcome to the
Alright,
show,
Camilo. Welcome to the
Good to
party.
have you. We've got Taylor Stone from Long Beach, California. New name.
I think that's a new name.
Another new name.
Right.
Lewis Hudnall, who is challenging us because he changed where he's from. Used to be from Milpitas, California. Now he's from Rockland, California. So we got to come up with a new nickname for him.
I don't know about this, Lewis. I mean, we were talking about this. You can't just go up and move your family and not take into account our nicknames and how we're going to introduce you on the Not Travis Best.
We got the mountain man in the house.
Bill Green.
Billy Green from the hiking trails of the mountains of Colorado. Good to have you. And we wouldn't be complete without announcing the fairy godmother in the house.
Jen Filson, of course.
And Chris Consaga.
From the illustrious Hudson Valley.
But he is chilling in Crescent Beach, St. Augustine right now. All right, we're going to jump right in. This is just a tease of the usual roll call. But GC, you like to start this market update kind of with some perspective, right?
You know, and it's funny, we talk about how important it is to have data with perspective. I like to get perspective on this call as well. And so I went back and I watched the quarterly update from the fourth quarter of 2022. And it was really interesting for me because if you remember, and we'll look at some of the graphs here in a minute here, the fourth quarter of 2022 in December, when we did the last quarterly call, the world was saying that real estate was going to crash again. And I started off the call by talking about how I feel the fear in the room and I feel the fear in our community and whatnot. But we talked a lot about having data with perspective, and that helped us allay a lot of our fears and continue to invest in real estate because we knew some of those temporary, declines in pricing were normal. It was called seasonality. And the other side of seasonality is what? Home prices would rise again in a few months as the summer season happens. And guess what, Pablo?
What, Greg?
Home prices are rising again in the summer months. So I think this quarterly call, I don't feel nearly as much kind of burden or fear in the community and our clients, and clients are continuing to invest. And that feels really nice to not have to kind of bring people back from a place where they were really scared. And so it's a good kind of segue here as you start to think about some of the national headlines here, I don't know if you have them there, Pablo, but I'll read some of them. Yeah. Let's go to some of there we go. So these are just some of the headlines. I just do a quick search of, home prices in the US to get a general sense. And you can see some of these headlines here. Home prices are up in the second quarter. Home prices are still on the rise. A record value of 47 trillion in the US housing market as inventory shortage fuels a price boom. Finally, people are understanding that this inventory shortage is a real driver of a high floor for home prices. And we have been talking about this quarter after quarter after quarter because this isn't something new. And even though the Fed has kept interest rates high, that's only one half of the equation for how the real estate market is performing. Right? That's the demand side. The supply side has been so low for so long. And I think people in a general sense are finally starting to realize this. And it makes this decision to keep investing in this asset class a little bit easier for a lot of people.
Yeah, these last two headlines specifically, right? This 47 trillion as the inventory shortage fuels, and the idea that the average American homeowner has nearly 200,000 in home equity are really ones that we've been talking about for a while. You've been talking about the supply side shortage for a while, and you've also been talking about this idea that it's a fallacy to think that home prices are going to take some kind of dip because there's some kind of mass exodus when so many people have had so much appreciation in their home and they're not going to walk away from that, right? There's too much meat on the bone for anybody that's bought a home in the last 4 or 5 years.
If you want the single greatest reason why this is not going to be the real estate crash of 2008, it's not going to happen right now. It's because of this incredible amount of home equity. Even if there are job losses, which probably will happen because the economy is slowing from what it was, you're going to find yourself in a position if you happen to lose your job or somebody happens to lose their job and they have a problem making their home payments, they are sitting on $200,000 of equity. And so their ability to sell that asset and still walk away with a lot of money in their pocket is there. And that is a wonderful thing for our overall housing market and our economy. It's not what we had in 2008. There were a lot of other reasons why 2008 was a crash, but these have all been things that we have said for quite a while now.
Yeah, as is commemorated here by my dumbfounded face and you telling me that it's not going to happen.
You know what? You were looking at me like, wow, I'm really buying what this guy's selling here. So I went back, as I mentioned, and look at some of the predictions that we made. And, this is what I said. And what is very clear based on the data is that home prices and home rents in Jacksonville are normalizing. This is not the real estate crash of 2008. Pablo, tell me the date on that one.
That is December 12th, 2022.
Thank you. Thank you for reading that. I appreciate that.
You're welcome.
That was interesting, right? That was December of 2022. And us in the Not Your Average Investor community think differently than what is portrayed in the general sense. And we together, as we rallied around this prediction, we're very different. We were not normal. We were going against the trend. But what you're seeing with home prices here is exactly as we predicted. And so it's a big win for all of us.
And as you predicted, we talk a lot about this idea of data with perspective on the show.
Mm-hmm.
And we often go to this chart in specific, right, which shows the Jacksonville median home price as over time, right, starting in maybe the year 2000, something like that, 2001,
Mm-hmm.
and through time. And we see kind of this like upward trend, this downward trend, and then this like long time upward trajectory overlaid over the median line of what the average home price appreciation is expected to be over time.
Exactly.
Which you often talk about is constant. As long as you average out over a full market cycle, this should be 4.6%.
That's right.
GC, I would assume.
Mm-hmm.
And where we were in December of 2022 was right around here, right?
Mm-hmm.
Like this had this huge run up and there was a little bit of a blip and everybody was talking about the sky falling. You want to explain what was happening?
Yeah, absolutely. It's called normal seasonality. If you go back and look at all of these different chunks of time, you'll see some up and some down, and the ups happen in the summer months and the downs happen in the winter months. And that's because there's just less demand out there. It's cold out there in the winter months. People aren't wanting to get out there and look at homes. And then, kids are in school, and, in the summer months, it's nicer weather. People are out looking for homes. That's a little bit easier for people to move as well. So it's just plain old seasonality. There's nothing to this,
Mm-hmm.
but that's why we knew that just because home values were coming down from last July to last January, that was normal. Almost every year without exception, home values come down from kind of June, July-ish to January of that year. And then from January to June, July-ish, guess what? They go right back up.
Yep.
I mean, that's how it is. And that's why you need to analyze home price appreciation on a year-over-year basis, not as has been reported on a month-by-month basis, because it can lead you to incomplete conclusions. And unfortunately, a lot of people out there have made poor decisions with their money based on those incomplete conclusions.
And I feel obliged to also say this is retail home prices, right? So you see this up and down. That is a good indicator of what the average price of a home is. This kind of seasonality, it's not all the same for when it comes to passive investing, turnkey rental properties as well, right, Jesse?
Exactly. It's not the same thing. You got to think about who the seller is, and the seller of a turnkey rental property has no motivation to drop their home price just because, it's quote unquote the winter time period, right? Because what's backing all of these assets, turnkey assets, is the same thing that you love when you own them. It's cash flow. Right? They pay for themselves every single month. So JWB or any reputable turnkey investment company out there is not simply going to drop their price because it's the wrong month of the year, right? They can just hold on to that asset and of course, sell it as the time comes. And that's one of the reasons why I love this business model so much. It's risk mitigated for you, but it's risk mitigated for JWB as well. So don't expect that sort of seasonality as far as pricing on your turnkey assets. Expect that if you're thinking about going and buying a personal home for yourself. Use that to your advantage and buy it in the winter.
Yeah, I love comparing your inventory. Like if I think of, Best Buy and them not selling something actually makes them money.
Yeah.
That's essentially what you guys do.
Yeah.
So
there you go.
It's not a bad business model, GC. So you said that the prices would normalize, and then you want to step further here. You said in 12/12, if the Fed only raises rates slightly in the next year, I can see home prices going up. If the Fed gets more aggressive with rates, I could see home prices going down. You could see a max home price appreciation of about 5% or a max decline of 10% over the next 2 years. This is you saying this 12 when everybody was saying the crash is coming.
That's right. And, click that one because look at what you thought when I said that, by the way.
I'm a very expressive person. I don't have a poker face.
You went from like really being on the edge of your seat with every word I said to like, nah, dude, I ain't buying that at all.
You probably just commented.
No, I just did. But I thought it was indicative of what many people were thinking at that time, right? At that time, people were thinking that this was going to be a crash. And I spent a lot of time evangelizing the message that it wasn't going to be. I had the opportunity to write in the Jacksonville Business Journal many times. There's article after article that I wrote because I wanted people to make sound decisions. And there were frankly better places to put your money than the stock market, and putting your money in rental properties here was a great decision in December, just like it is right now.
Got it. So those were your predictions in December.
I did want to make one special note about that too, because I went and I was like, okay, well, how aggressive has the Fed been, or how conservative has the Fed been, right? Because what I said was if the Fed would keep rates consistent, then I could see home price appreciation. If I said the Fed was aggressive as far as raising rates, you could see a decline. Well, the Fed has really been right in the middle there. They haven't been conservative. They've actually raised interest rates 1.5 points since we went on record with that. They had a 0.5 point increase, and then they've had multiple 0.25 point increases after that. And they actually paused, and then we'll see what happens as well in the next meeting for the Fed making that decision. So they haven't kept it consistent. They've raised it, but they've slowed the rate of the increases. And so what you're seeing overall is, prices are a little bit positive year over year, nothing to brag about or whatnot, but certainly not negative, and certainly not this crash that was being predicted out there. And I think that's really closely tied to the Fed's activity. Kind of been right in that they're raising them. They've raised them more than we all want, but it certainly hasn't been this aggressive push that they had for the year prior.
Got it. So this is the segment of the show that we call, that's why so many people show up to listen to Gregg, because you've been largely right about this stuff when headlines and other people talk up and down of a market being more volatile than it is. We talk about this idea of data, which some people have, right? And they can talk about it, but it's data plus perspective. It's this wide perspective of the time that you've been here, 17 years doing this thing. So you've seen a market cycle play out. It's also the perspective that you have of seeing the 5,400 properties that you manage and all the different activity that you see come through, right?
And I have my own money on the line right next to you guys.
Yeah.
So there's a lot of incentives for me to get this right. And we have a tremendous team that works really hard to make sure that we have this data. And it's not just macro level data. We get into some of the KPIs for the company, right? This data helps you. This data helps you make better decisions. And it's not data that you typically get when you make an investment in real estate with a real estate agent. Correct. Or even in a fund or a private placement or some type of syndication. You don't have access to this type of data. It's some way that we want to differentiate ourselves. And it's nice to get it right. We're not going to get it right every single time, but it's nice to get it right because I want you all to keep showing up because there's real value for being here.
Got it. So we have some data to share with you. We got some questions in the Q&A, but first we have the current data to share with you and we'll answer your questions before we get to some of Gregg's takes, right? But right now we're going to go back to this sheet that you put together, GC, and let's talk about some of this stuff.
Yeah. So what's driving this high floor of pricing amidst higher than we want interest rates is the extreme housing shortage that we have had for well over a decade. And we still continue to have an extreme housing shortage. I wanted to let everybody know that inventory levels in 2023 are actually dropping. Inventory is down 13% from November of 2022, and we're down 15% from July of 2019, pre-pandemic. So when we were talking about how there was a lack of inventory pre-pandemic, and that's why home prices were rising at an above average rate, we are at 15% below that level of inventory. This is a good thing for us who own assets, because when you have low inventory, this keeps prices high. The floor for prices high keeps them stable. And while it might not be a good thing for everybody overall, meaning it leads to affordability challenges, and certainly that's a concern out there. When you own the asset and there's a low shortage, it's good to own more of that asset.
Got it. And these are, this is current stats right now. Are these, would you call this like a leading indicator or a tailing indicator right now, these shortages?
I'd say it's a right now indicator and it's a leading indicator because it takes a long time to solve the shortage of housing crisis. And you're reading a lot of articles in the news about this. And there's a lot of policy that is hopefully changing to make it easier to build inventory, because we have to build ourselves out of this inventory shortage, but it's not going to happen overnight. So that's why you're going to continue to see upward pressure on housing prices in Jacksonville and across the country over the next 3 years and beyond.
Got it. And before we go into some more of these leading indicators, GC, as a rental property investor, why am I concerned with housing prices? Like, can we set the standard for why we're looking at this idea of housing prices?
Sure. Let me take both sides of that. I'll tell you why you should be concerned about it, and then why you shouldn't be concerned about it.
Yeah, what I mean by concern is, why am I paying attention to housing prices, right? We're gonna talk about where they're going, but like, what is the context to analyze this stuff with?
At the end of the day, there are 5 profit centers that are going to comprise your total return on investment in your single family rental property portfolio with JWB, or however you own that. And out of those 5 profit centers, they are not all created equal. Over time, over a full market cycle, when you sit back and look at how you created this return on investment for yourself, what you're going to find is that home price appreciation is going to make up the largest part of the pie for you. We review it every single week. We go through portfolio of the week, and every single week I show you what is the percentage of total return on investment that comes from each profit center. The one that is between 60 to 80% of your total return on investment, regardless of the client, regardless of when they purchased, between 60 to 80% is home price appreciation. So you all have made an incredible decision to invest in a growth market like Jacksonville, and that is going to serve you really well long-term. So why is it important for us to pay attention to home price appreciation? Because it is the biggest contributor to your returns. It's important to pay attention to it in the long run, though. What is not so critical, but something I give you insight into, but what is not so critical is, what is home pricing today to next year? Because this is a buy and hold investment for you. And over the long haul, what data shows is that it's going to get right back to what that historical norm is, or very close to it. And that historical norm for Jacksonville is 4.6%.
Got it. So you mentioned 5 profit centers, right? Mm-hmm. It is, you mentioned home price appreciation, there's cash flow, there's tax savings, there's debt pay down, and then there's inflation hedging as well, right? Mm-hmm. And one of the key things that we talk about on this show week in, week out, what we talk about in the class that we put out, is this idea that the way that you win in rental properties for buy and hold is to make sure that your short-term scenario is livable, right? Like it is not burdensome on you, right? Mm-hmm. That means having either equal or positive cash flow, right? Mm-hmm. Like not dipping too much into your cash flow on a monthly basis, having a great team that handles this, whether you are active or passive, you need to have a great team that handles this thing. And that allows you to stay in for the long run, which means that your home price appreciation becomes this big piece of the pie as your cash flow continues to grow and increase, because rents go up over time as well. So that is why we position this. That's why we lead with home price appreciation, because at the end of the day, like Gregg said, we show these pie charts weekly, and the pie chart looks like a Pac-Man, and the Pac-Man is home price appreciation. The mouth of the Pac-Man is these other profit centers over time. So if you want more information on that, and this idea of you need to find a team that does this thing for you so that you can be in it for the long run, you go to chatwithjwb.com, you pick a time to talk to them, and they're going to talk to you about kind of like where you find better capital, more capital for you, and then what that capital can do for you as a first call. So that is the first call that you take. You go to chatwithjwb.com if you want to find out more about that part of it. But for now, let's get a little bit more into the stats, GC. So we're talking about home price appreciation. And one of the big statistical indicators that you've been really leaning on for as long as I've known you.
Guys, I talk about it every single month.
Is MOI. Tell me more about MOI.
In every single quarterly call, we talk about MOI. It's because it's that important, right? This is one of the most important metrics that we look at when thinking about where home prices are going to be 1 year from now. And so just a quick reminder, months of inventory is where you take the existing amount of inventory on the market and you divide it by the number of home sales that happened the month before. And over time, if you see an MOI, months of inventory, if you take that equation and it's between 6 to 7, you would expect average home price appreciation for your market. In Jacksonville, that happens to be 4.6% home price appreciation. If it's MOI less than 6, months of inventory less than 6, that means that you're going to see upward pressure on pricing. You're going to expect higher than normal home price appreciation. If we would get to an MOI over 7, that's where you would expect to see lower than average home price appreciation. And I think it's really telling as we start to look at what has happened in history that this is a very strong leading indicator as far as where home prices are going to go.
There you go. So now if we're going to talk about MOI, December 2007 was the worst part of
that was interesting.
Going into the Great Recession, MOI was at 18.1%. So you saw 10% depreciation over the next 12 months. June 2009, it was still at 10.9, well above that historical average. You saw depreciation of 9.8. Then October of 2014, I think when everybody wishes that they had a time machine and could go back and invest in Jacksonville properties, it was at 4.9 and you started seeing 7.3%. October 2016 at 3.9 of MOI, you saw 8.4% home price appreciation. Should I keep going here, GC?
I think we're just trying to paint the picture. Yeah. And the next slide paints the picture a little bit more. The punchline here is when you're less than 6 MOI, you are set up for higher than normal home price appreciation when it's a normal market. This is not a normal market because you've got the Fed's influence, which is the great variable out there. But what this should make you feel very confident in is that this is not the crash of 2008. I'll say it over and over again. There is a really high floor at the bare minimum. And quite honestly, if the Fed would ease up on interest rates, I could see home prices going up substantially again. Got it.
So you can see home prices going up substantially again if they ease up on interest rates. But as it stands right now, July 2023, we're at 2.9 of MOI, right?
That's right.
So this indicator that affects, it's one of your better leading indicators, shows to be very, very promising.
It is lower than what it was pre-pandemic.
It was lower than what it was pre-pandemic, and pre-pandemic things shot up.
Yes.
Big time. Okay, cool. So let's talk about actual housing months of inventory data right now.
Yeah. So we'll look over the years here. So back July of 2021, we had a little over 4,000 homes on the market. We had about 3,600 sales, which we hadn't had over 3,000 sales in the Jacksonville market before the year 2020. That was the first time we ever crossed that. So in July 2021, things were absolutely raging. Home price appreciation was raging. Interest rates were incredibly low. And months of inventory was almost the lowest I had ever seen it. It was around 1 month of inventory. And everything was set up for way higher than normal home price appreciation. July of 2022, we saw the number of houses on the market increase. It had to increase, right? This is where you might read articles and they say, oh, wow, inventory increased 50% year over year in July 2022. And I'm like, guys, that's data without perspective, because I remember in 2007 when there were 18,000 houses on the market in 1 month. So 6,000 is totally fine, right? We had about 2,600 sales, which is great for a July historically for Jacksonville. And again, 2.4 months of inventory in July 2022. That's again why we saw higher than normal home price appreciation all through 2022. July 2023, again, houses on market are, in the 6,700 range here. People were calling for a ton of inventory to hit the market, and they were calling for home prices to go way down. We're not seeing that. And people are finally realizing that these super low interest rates that people have for their mortgages, 3% interest rates, 4% more interest rates, are keeping people in their homes. Home price affordability is a real challenge now. So people are absolutely staying in their homes, not listing their home. That is keeping inventory levels lower, which is keeping your months of inventory levels lower, which is keeping home prices high and consistent.
So that's something that, let's unpack that just for a second, right? Because right now what you're painting a picture of an appreciating home market with this, based on this variable. You've also caveated it by saying that the Fed is a significant variable in this equation. If they go bananas and start jacking up interest rates, there's a chance that the market doesn't behave exactly like it did correlated to MOI the way that it's done.
Mhm.
You're also just indicating right now that something we talk about a lot, week in, week out. It's this idea that this is a very resilient asset in the sense that even though the Fed has brought up the interest rates, which should say that home prices should not go up as fast or maybe even go down, bringing up the interest rates also does something else, which is keeps people in their homes, which makes them not sell, which keeps supply way down,
Mhm.
right? So because of that, it's this combination of low MOI, people moving to Jacksonville that we haven't talked about yet,
Mhm.
but also the fact that when the Feds put the interest rates up, folks have not brought their home to market to sell because they want to just keep this like really nice low mortgage that they got going on. And that keeps inventory for sale down, which keeps supply down. And as demand stays constant or increases, home prices, property values continue to rise.
100%.
Okay.
You know what else it does?
What?
It increases rental demand. Because if interest rates stay high and home price affordability is a challenge, you take those would-be buyers out of the pool, they become renters. One of the reasons that I love this asset class is you can win in so many different ways.
Yeah. That brings me to Robert Solomon's questions. We're talking a lot about house prices. How are rental prices being affected by all of this?
Strong. Historically, rents grow between 3 to 4% per year, and we're expecting about 3.5% rent growth this year. And that's largely what we're seeing.
Okay, there you go. And I can, I'm a data point in all of this, right? Like I'm somebody that's been renting since I've been in Jacksonville. I've invested in a couple of rental properties, but as I look at, for me, buying a home was a personal decision. And for me, it was about building my business up to be a certain level of stability. And then I'm going to go buy my primary residence. But in the meantime, I invested in rental properties because they cash flow and they appreciate and all this stuff. As I look right now at the housing stock and whatnot, it's keeping me renting as well, right?
Sure.
Because what I can buy right now based on interest rates, it's keeping me out of that game, which keeps me paying higher and higher rents every single year, even though I'm not in this workforce class. I'm still paying rent. It's still going up and I'm still happy about it.
Yeah. Well, it's the same dynamic for you as it is for our residents in our workforce housing neighborhoods, right? It's pushing to rental demand, which is one reason why rents are staying high and consistent.
Okay. So before we get into Q&A, GC, we have a little bit, another wrinkle of this, of what's going to affect housing prices. And we talk a lot about downtown Jacksonville on this show. GC, why do we talk so much about downtown Jacksonville?
Downtown represents the single greatest opportunity for me to overperform for your assets compared to what I told you they're going to do. When downtown comes online for Jacksonville, if that happens, when it happens, it's going to follow a similar model as we've seen in Nashville, Tampa, Austin, Charlotte, Denver. These successful downtowns that have come online. And the greatest place to invest for risk-adjusted returns is in workforce housing neighborhoods 15 miles or less from the downtown city center that is revitalized. And so this is a significant opportunity for us to overperform for you, because in those evaluations that you guys make decisions on, I don't put in the downtown effect. So this is that classic under promise and over deliver moment and opportunity for JWB. And I am trying to shed a light on it as much as possible because there's a real urgency to this. And that's why I wanted to put some stats together to show some of the leading indicators of when a downtown comes online, because when a downtown comes online, home prices and rents and median incomes in that area and then those surrounding workforce housing neighborhoods, they go up. If anybody lives in Nashville or anybody lives in Tampa who's on the call now, would love to hear you chime in and say, talk about the rents and home prices in the surrounding neighborhoods around your downtown. And that is what we see happening in Jacksonville.
Yeah. And, we refer to it as the curve bends, right? Because all of a sudden there's this home price appreciation rate that's been happening. Downtown comes online, becomes a complete city, starts attracting Fortune 500 companies left and right. All of a sudden, median income rises in the city, and therefore people can pay more rents, can buy more houses, and it starts to go up, a la Nashville. I live this in Miami, right? Like I personally live this in Miami, and I represent one of those folks that saw it in Miami, is seeing the pattern recognition here in Jacksonville, and wants to get in because I didn't do it in Miami. And I equate this. We did a show last week about picking cities like you pick stocks. I equate this to like a really hot stock tip, right? Like this is, hey, AI is about to go crazy. You can't do AI without NVIDIA stock. You should buy NVIDIA right now.
Yeah.
Right.
Yeah.
A mistake that I did not do also, for the record. So let's talk about these stats with downtown, GC. I know you're pumped about these.
Yeah, I am, because, it's not so hard to understand when a downtown is about to come online or blow up or really start to see increased levels of home price appreciation and rent price appreciation in the surrounding neighborhoods. You can just follow a model of other downtowns and seeing what their effect has been. So that's why the leadership in our city, and my business partner, Alex, who's our president, is a part of Leadership Jacksonville and has been with our city leaders to these other downtowns. We go to these downtowns and we understand, how did you do it? And then we understand what happened after you did it, right? And how do you keep growing afterwards?
I saw Alex talking at a TEDx salon last night about downtown, talking about these cities and whatnot.
So we've actually seen, it's not this great myth of like it happens without any warning. There's clear signs of when a downtown is ready to grow. And one of those clear signs is when your downtown gets to 10,000 residents. I was actually doing the research over the weekend. I thought that this goal for Jacksonville to get to 10,000 residents was like in the last 3-5 years. It's been a 20-year goal for Jacksonville to get to downtown resident population, 10,000 residents. And the reason is because in these other cities, when they eclipsed the 10,000 residents mark, big things started happening. That flywheel effect started happening. People are living downtown. More bars and restaurants and amenities pop up to serve those people who are living downtown. Living downtown becomes an amenity in itself for your workforce, and your workforce wants to live downtown. More companies come downtown that are local, and more companies from outside of the area come to Jacksonville. And when this happens, that's when median incomes start to rise. And I know we talk a lot about how challenging home price affordability is, and we tend to think, all we can do about it is hope for home prices to come down. Well, that's not true. We can raise median incomes. Home prices can still go up, and we can raise median incomes, and home prices can become more and more affordable. And so we have the opportunity to do that here in downtown Jacksonville. Those median incomes rising, and rents and home prices in our JWB neighborhoods, workforce housing within 15 miles of downtown, seeing significantly higher home price and rent price growth.
Yeah. And I remember when we first started this show, Daniel Davis was one of our first guests. And I remember we were here, right? We were in this 6,800 people downtown. He gave us that statistics of 10,000. We knew that Jacksonville had been at around 3,000 for forever. And in 2017, it started growing. And he gave us this projection of within 5 years, he thinks it's going to end up happening. And now what it looks like is this idea that right now we're at almost 7,500. And they believe that by the end of next year, we are going to be beyond that 10,000 threshold, which is that curve bending threshold, that moment where downtown tips, outside investors start pouring in. They don't need incentives to do it. People start moving to downtown en masse because it's higher quality of living and it becomes an amenity all unto itself. And that is when all of the homes around downtown and that whole area start to have a whole nother sense of value that gets added to this thing. It's like a black swan event of increased appreciation.
100%. 100%. So yes, and I should point out that this 10,155 number is a projection, but this isn't like your regular old projection just to make this look good. This is based on projects, the 24 projects that are being completed or are completed in downtown Jacksonville right now. Like they got approved years ago. They raised the money years ago. They started the construction years ago. They're completed now or soon. And when those projects are open for rent and you fill those homes with residents, that's how you get to this 10,155 number. This is not a pie in the sky number. This is going to happen.
It's going to happen. And there's something else that backs that up. It's the money being spent.
Yeah. So I started to put this data together not too long ago, and it still blows my mind whenever I look at it. This is the first time I put it in a chart.
Yeah.
So what this is showing is the active development dollars in downtown Jacksonville. And so in 2017, we had $719 million of active development. This means projects that are under construction or in the final review process of this construction in downtown, right? This is funds have been raised, renderings have been completed, conceptual designs have been completed, final designs have been completed, bids are in and ground is moving and cranes are moving, bulldozers, this is happening right now. So we had 719 million in 2017. This year, 2022, these are not projections. This is this year, which completed in 2022. We had over $4 billion of active development dollars here in sleepy old Jacksonville. I went to Washington, D.C. not too long ago. I happened to look at what the amount of active development dollars they have in their downtown. 1 billion. I've never felt like 1 billion was small until I realized that Jacksonville has $4 billion of active construction. So you want to think about a leading indicator?
Yeah.
Like this is what active construction, this was like in the ground. And some of these projects are going to take 2 years, 3 years, 5 years. This is your leading indicator. Mm-hmm. If we go to the previous slide, you don't have to, but if you go to the previous slide, that 10,155, that's already baked in. That's already done. This is your leading indicator for where downtown is going to be. And that's why I'm trying to sound the alarms for urgency, because this represents an opportunity before this effect happens on residents and median incomes and home prices and rents.
And when I look at this chart, GC, I see a significant jump between 2018 and 2019, right? Like 2017 and 2018, it's like a jump of $200 million. And then bam, like 1.9 more billion. And then another, like you start getting up in like much bigger numbers at a different echelon. To me, if we're talking about like a leading indicator, I see this as like somewhere between 2018 and 2019, the big money started really believing it, right? Like they started just coming in heavy. And this number that we're seeing of population growth to 10,000, if it's going to track behind projects being completed, we're seeing kind of like a big step happen from this year to next year. And that seems like that might be the first big step that is going to continue to happen if it's going to follow this chart, right?
Yeah, I would probably go back a couple of years before 2019 and 2020. So in order to get to this active development stage, you had to pass by the proposed development stage. Mm-hmm. So if you think about when big money locally here started to really believe, they had to believe in it. Then they had to believe in it enough to propose it to the Downtown Investment Authority. Mm-hmm. Then they had to believe in it even more to actually putting, shovel in the ground and cranes and bulldozers and things like that. So if you're seeing that in 2019, 2020, like we are, the real shift of sentiment probably started happening 2 to 3 years before that. And that's really where we started to get our coordination, I think, between public and private investment.
Yeah. And let's talk about what these things ended up being.
Yeah,
they're looking like.
So I thought this is cool. And we'll certainly explore this more on the show as we have more and more time. But I wanted to put together a visual of downtown Jacksonville and overlay it with those projects that are happening right now, that $4 billion of projects here, because it's not just in one area. This is the downtown area, but you can see all of downtown right now is spread out with $4 billion of projects, right? So we'll just highlight a few of these, but these are some of the ones that are making the most headlines or have the most dollars. Yeah. The Shipyards project and the Four Seasons project. We're going to have a Four Seasons hotel in downtown Jacksonville. It'll be our first 5-star hotel. And this is made possible through the owner of the Jacksonville Jaguars, Shad Khan, who also owns Four Seasons across the world, his connection to bring the Four Seasons down here, to believe in the downtown market of Jacksonville. It's kind of like one of those major developers coming in and saying, oh, I believe enough in this market. Other 5-star hotels, other 5-star and premium service providers say, that's great. You know what else happens? When employers want to come down and have clients come and visit, they say, oh, you guys have a Four Seasons? Oh, that's awesome. Yeah, let's do more business in Jacksonville. Maybe we'll relocate to downtown Jacksonville. Yeah. It's this flywheel effect. So this project's happening right now. This is beyond proposed. This is approved, happening. Shad Khan and Iguana Investments, which is his investment arm, are contributing over $300 million of their own money to make this happen. Four Seasons, Marina, Class A office space, and some high-end residential will totally transform this area, which is right next to the stadium. This is a big one. I can't state how important this one is. It just doesn't do it justice just to show a slide here. But this is the UF Satellite Campus, graduate level studies campus here in downtown Jacksonville. And again, this isn't proposed. The money has already been raised on the city level, on the private level, on the city level, and on the state level. This is happening. It is going to be in downtown Jacksonville. And if you want to raise median incomes, the best thing you can do is have a flywheel of talent. And a flywheel of talent attracts high-level jobs, which bring high-level incomes. And you can see how this flywheel effect happens. So this satellite campus is going to focus on fintech and health tech. Wonderful, wonderful, industries to be a part of. And if you can think of two industries that lead to higher wages and higher incomes, can you think of two others that would be higher than this, Pablo?
No, I mean, it's right in line with stuff that is only going to be a growing demand for jobs, only going to be growing demand for specialization in this stuff, right? Like we're getting older, our financial systems are getting more and more complicated and more driven by data. The other thing that I find really, really interesting about this UF satellite campus is that it's also, UF has the biggest AI supercomputer in North America, I think it is.
Yeah, I know.
And
so proud of our alma mater there.
And this is Go Gators. And this is health tech and fintech powered by AI, right? So like if you want to get real buzzwordy and you want to get really into the future economy and what the high paying jobs are going to come from and the talent that you can attract in order to do this, you equip these two verticals with the biggest, most important tool that you could possibly give them. And now you're bringing the best talent in the country, the best talent across the world to come be a part of this. And as I said, I come from Miami. I lived this downtown Miami boom. I was also very intimately involved with downtown economic development and the building out of the tech ecosystem over there. I remember the one thing that we couldn't bring. We could bring a Four Seasons, right? We could bring billionaires.
True.
The one thing that the Miami ecosystem would have absolutely killed for is a world-class institution that fed top-level talent, right? Like it's no coincidence that Silicon Valley is Silicon Valley because it's fed by Cal and Stanford, and Boston ecosystem is what Boston is because it's got MIT and Harvard.
Mhm.
It is absolutely crucial if you really want to make a big splash to be known as the ecosystem for a specific kind of vertical for technology, for these kinds of things. The employers need access to talent that they can give internships to, that they can leverage the research of in order to bring things to market in an inexpensive way, and then hire those people to lead those projects. I think this is a huge driver.
I can't state how important this is enough.
Yeah.
This one is huge for us. And everything I'm showing you here is going to be here in the next 5 years. This is not like proposed and done 10 years from now. Like this is the next 5 years. And some of these things are in the next 2.
Yeah, got it. And Juan Duque had actually asked about this in the Q&A. He's also asking your thoughts about the Emerald Trail, which I don't think is part of this whole slide, but
I wish I could. It is a part of the presentation that we do for onboarding clients and whatnot.
Mhm.
But the Emerald Trail is a big catalyst. You look at other successful downtowns and they make it easy to walk through different parts of downtown, and businesses spring up along those trailheads, and we have that same thing being built right now in Jacksonville. It's called the Emerald Trail. Would encourage you to do a Google search and learn a little bit more about it. And maybe we can highlight it on a future show as well.
Yeah, definitely. And what I can tell you about that is coming from the world that I came from in Miami, having had a former land use attorney as a former client, trail-oriented development is some of the highest ROI development possible, right? Like they talk about transit-oriented development that incentivizes public transportation being super high ROI. Trail-oriented development is another buzzword that you want to start looking at because that is a super, super high ROI public-private development activity that you'll get to look into.
I never knew the trail-oriented one. I like that.
Now you know, big guy.
All right, let's talk about the Jag Stadium renovation.
We all know about this one.
I think we all do. This created such a buzz. So excited about it, right? This is a $2 billion project here that the Jags and the city are working together on. But this is going to set up not just our city to make the most of our relationship with the Jaguars, but it's going to set us up to host world-class concerts, huge sporting events, you name it. This is going to put Jacksonville on the map for some of those opportunities that we get passed over for now. And again, this is not just a stadium renovation. This is a renovation and a development of the surrounding neighborhoods around the stadium as well. It's about $1.4 billion for the stadium, $2 billion overall. And so excited for this to happen. We're in negotiations, or negotiations are starting soon with the Jags and our great mayor, Donna Deegan, and her administration. And we hope to have those negotiations wrapped up kind of early to mid next year. And all signs are that everybody wants to make this happen because this is a great deal for the Jags and this is a great deal for the city, and we can all win here.
We did a whole show on this when they made the announcement. I think it's worth checking out. Maybe Madison, you want to share it in the chat. You can see it on YouTube. You can see it on the podcast. If you don't subscribe to the podcast or the YouTube channel and you're into this kind of content, we'd love to have you, right? Just look for the Not Your Average Investor show in your podcast platform or your YouTube channel and check it out. And then you see one more here. Let's talk about this one.
Yeah. I want you guys to know that we put our money where our mouth is. So a few years ago, we looked at the leading indicators of how downtowns come online, a la the stats that I just showed you, and we became incredibly committed to being a pioneer in downtown Jacksonville. And so to date, we've invested over $68 million of our own money. We own the equivalent of 20 city blocks in downtown Jacksonville, and that's about 12% of the North Bank of downtown Jacksonville. Really excited that our first two major renovations have just come online. This is known as 218 Church Street and the Federal Reserve Building. These are renderings of those two projects, and the 218 Church Street buildings on the right here, that's open and it's already rented. There's 24 studio apartments and those are rented right now. So you're seeing how resident population is increasing. Well, that's what we're seeing. We're happy to contribute to that. And Federal Reserve is just about to be opened up, and we have we're very close to signing a long-term lease with a wonderful tenant there. That's going to be a commercial, retail space and a number of retail spaces there. So I want you all to know that everything that I'm advising for you as far as taking advantage of the opportunity of investing in workforce housing surrounding downtown, we believe in, and we're a part of it because of our big investment in downtown Jacksonville, which you see here.
So GC, I think that what you have painted is a very attractive picture of a market where property values look like they're going to continue to go up. You've also painted a potential game changer where they're gonna at one point gonna massively go up, right? Like there's going to be like an inflection point where it's going to become a bloodbath, right? Like everybody's is going to want to get in at some point. It's going to rapidly accelerate. Can you speak a little bit to investing in downtown proper, right? Like we're painting downtown as this like high catalyst. Is that the move that you were suggesting?
No, investing in downtown proper, right, would be you I always say taking down. I'm trying to remove that from my vernacular here, right? Would be you renovating or a building that has been vacant for many times 30 years or 40 years, or you going and building new construction in downtown Jacksonville. And there is so much risk in that I don't believe that's the best risk-adjusted returns for you. It doesn't really fit what our clients want. Sure, you can make a lot of money if you're in for the long haul. JWB hopes to do quite well on these investments, but it's not this year. It's not next year. It's not in 5 years, right? Yeah. We're going to own these things for a very, very long time, and it's super risky. So the best thing for you to do is to not try to go and invest in a downtown building and take on that outsized risk. The best thing for you to do is to invest in risk mitigated assets that get this indirect benefit of increased home price appreciation and rents. And that's why I'm advising and advocating for you to invest around downtown in these workforce housing neighborhoods that we have been serving for 17 years now, because that's where your risk is mitigated because you have positive cash flow, right? And you're going to see the effects of the home price appreciation and rent price appreciation because of what JWB and others are doing in downtown.
Got it. So it's this idea of, we just showed the chart of all these projects. These are very expensive, risky, sophisticated projects. That is people with a really big bankroll are coming in and having a long view of this, right? You guys uniquely are able to take an extra long view of this because you know that investing in your downtown is going to make the rest of your investors and your own investments do better. Kind of like Shad Khan can invest in a stadium because he's also got a hotel deal going in.
Exactly.
Right.
Exactly.
So there's a lot of this like complementary activity. What I heard yesterday in this TED talk that Alex was talking about was that rents in downtown need to pencil in at like $2,400, $2,600 for like a 1,000 square foot space. Mm-hmm. That is, that is discretionary income rent, right? Like nobody in the work, nobody that isn't thinking that they can, spend a little extra on rent to have a higher lifestyle is going to rent that. That's going to be people in the middle upper class that are doing that, not the workforce housing stock that is cash flow positive day one, right?
So just to illustrate the point, right?
Yeah.
So that would be $2.40 per square foot for rents for a $2,400 rent for 1,000 square foot, unit. Right. Workforce housing, where we invest, our average rents are about $1,400 and our average square feet is about $1,400. So you're talking about $1 per square foot. That's workforce housing.
That's workforce housing.
Right. Yeah. When you're talking about $2.40, that's not workforce. That is, higher income.
That's higher. That's higher than my rent.
Right? Yes. And that there's inherent risks that come along with investing in that type of inventory. That is not risk mitigated like what we do is.
Correct. Yeah. Let's talk a little bit about rent. We got some Q&A about rent because at the end of the day, we're talking about home price appreciation if you can stay in the game, right? So what you need to do in order to get the benefits of home price appreciation is have a really good team in place and buy an asset that pays for itself and allows you to stay in the game without pain, that you can continue to reinvest in and be there for the home price appreciation. So we're going to talk about the strength of the JWB team in a second. But as far as the strength of the asset itself, there's home price appreciation, and then there's the rents piece. There's a couple questions here about rents. First of all, Miguel Angel Sanudo says, don't you see a top in house pricing when affordability becomes impossible?
If median incomes don't go up and house prices continue to go way up, and if interest rates there was never some easing on interest rates, eventually you would get there. I just don't foresee that happening. I see interest rates coming down eventually. I do see home prices going up in markets like Jacksonville, because Jacksonville is an affordable market compared to others in the country, which means that we have a longer runway before this would become a challenge. Yeah. And guys, we're talking about, the effect of downtown. We can win together by raising median incomes. This can be done. And downtown represents the greatest opportunity for us in our city to raise median incomes. And so to answer your question, no, I don't see that happening in our Jacksonville market where it would top out and we wouldn't have any more potential for home price appreciation. I think there's a lot of other things that will happen before that will continue to see home prices go up and rents go up.
Listen, Greg, I love your answer because it's the right answer. It's the right way to approach it, is raise median incomes so that the market can continue to do better. The rising tide floats all boats, right? I think the other side of this equation, Miguel Angel, is the idea that there is still people, like Jacksonville is still severely underpriced in comparison to Miami, New York, Boston, Tampa, right down the street. We still have, I think it's like 80 something people moving here per day. And at the end of the day, what's beautiful about what's happening now with the downtown play is that they're building this place for the people that are from here to still be able to afford this place, right? If that doesn't actually work, there's still going to be a ton of people that are not from here that can really afford this place and are going to still continue to pour into one of the best weathers in the country, this beautiful lifestyle next to the beach, this Florida low tax situation, and continuing job opportunities, right? So like way before we price out the local, like way before we get to the ramification of locals not being able to get there, people from the outside are going to be buying this stuff up and are going to continue to drive prices up.
Well said.
Because I've seen it.
Yeah.
Right. Like that's what happened in Miami. So our friend of the show, Mark Meisberger, the mayor of Laguna Beach.
There we go.
Yeah. He's got a question. Rents and showings appear to be softening. Please elaborate on the changing of the rent adjustment process recently implemented and asking rent adjusted based on showing activity.
Asking rent adjust. Well, so I'll just talk about it in generalities, right? If we're comparing what it was happening last year till this year, absolutely they're softening. This is, again, data with perspective here. The market right now for renting is very normal. It's that we're coming off of an abnormal, incredibly hot renting market a year ago and the year before that makes it maybe feel abnormal. But our homes on market are right in line with our historical standards. It's more than what it was a year ago because it probably should have been more than what it was a year ago. And so as far as, changes in standards, we're always working closely with our clients and making sure that, we're doing the right thing by your return on investment. And, sometimes, we think it's going to rent for a certain amount, and after a certain number of days, we're going to adjust the rent. And sometimes that happens. It's not a perfect science. But we're always trying to deliver the best return on investment for you. And so that's our charge. That's what we do.
Yeah. And then again, if you like this picture that's being painted and you want to, get the ball rolling, you want to ask about your own situation where you can find more capital, what your capital will actually do when you put it into work, go to chatwithjwb.com. But based on Mark's question, I think it's time that we get into like how the actual JWB stock is performing.
Mm-hmm.
Like we said, this thing only works if you have a great team that you can trust doing this thing for you. So you're in it for the long haul. So let's see what that looks like. Oh, wrong thing that I'm sharing.
We were so close. I was getting ready to go. And then, hurry up and wait over here, Pablo. Yeah. So these are the company update, the JWB stats, and this is through July of 2023. I just want to give you an overall picture of the activity that's going on inside the walls that you may or may not, realize as part of a vertically integrated company, but constantly acquiring assets that will turn into turnkey investment properties for you all in the future. So purchased about 70 or so this year, continuing to build out a tremendous amount of new construction homes. We've completed over 150 this year, which is in line with our projections of a little over 300 new builds this year. Just that alone, building over 300 houses in a year puts us very high on the top 10 of just builders in Jacksonville. Yeah. So a lot to be said for our new construction and construction overall team. They do an incredible job, and that delivers a lot of value for you as property management clients as well in many, many areas when you think about the level of activity that is completed and the economies of scale. Construction on the reno side, still completing renovations as well. And, you're reading all these headlines saying that home sales are slow and things aren't moving. That's not how it is at JWB, right? We sold almost 200 homes through July, which is, right in line with what our business plan is and what it's been in past years.
There you go. I mean, to me, the big takeaway, this activity, this new construction and renos completed, and the fact they're going to do 300 in a year, to me, that's economies of scale, of purchasing power, of influence with contractors, of all the things that you need in order to keep an asset working and having people around. So I just find that really, really impressive. As an investor, I value it from that perspective.
Now let's go to property management, because I think, if your property management team is performing well, you're going to be in this asset class for a long, long time. And I'm just so proud of our team to be able to deliver this over and over and over again. Yeah. If you go back and look at past quarterly calls, these numbers are very consistent, and the only exception would be that they get better. So, 98.5% rent collection. If we go back to the pandemic, when we had eviction moratoriums, we still were collecting over 98% of rent. And that's a credit to our team. And it's a credit to your decision to invest in this asset class, which is way more consistent than traditional stocks and bonds. So super proud of 98.5% rents collected through July of this year. Our average rent per property eclipsed the $1,400 mark, which is really wonderful for all of us. Rents continue to go up was it Mark's question earlier about rent softening? Rents continuing to go up for our average portfolio, our average property in our portfolio. And current properties under management. We've acquired 2 property management companies this year. And through that and through our organic approach of adding new properties under management, we're up to almost 5,500 properties. And we just celebrated going over 5,000 properties. I feel like a hop, skip, and a jump ago.
Like that was just man. Yeah.
So we're up to just about 5,500 properties here. This is really important for all of you. From a business perspective, this type of income for a real estate company is not normal. Most real estate companies are built for boom and bust, not our company. The backbone of our financials is our property management company. Mm-hmm. And that should create a lot of confidence in all of you that not only are we going to be here today to serve you, that we're going to be here in the future. And that's the value of the vertically integrated approach.
This combination of being able to bring homes to market, and also manage this many properties, just to illustrate your boom and bust thing, right? If all you do is build and bring homes to market, when the market goes down and you can't build that much, you are laying people off, you're shuttering your doors, you don't have inventory for your investors. And also, so you have the property management side of it that is recurring revenue, that keeps the lights on, that keeps things humming along and makes a real stable thing. But if you do it the other way and you also only have a portfolio management, right? Like a property management company and not selling investment properties, then you have to operate like the typical rental, the typical
property
management company, which means that you make the majority of your money on fees, right?
Yeah.
So this combination of the two allows you guys to really create the stable piece on the investment side that allows you to withstand boom and bust. That's why when a whole bunch of investment companies here in Jacksonville closed their doors recently, you guys have not let anybody go.
Nobody was let go anytime here. Nobody was let go during the pandemic because of, economic issues, right? That doesn't happen at JWB. And that's really important to us because behind all these investments is the team. That's what you're investing. That should be the number one reason you invest with us. And what brings strength to the team is our culture and making sure that we're taking care of every single teammate, thinking ahead for those teammates is how we build that foundation. And eventually it comes to the surface in your client experience being better.
Yeah, there you go. And again, the whole, how does JW make their money? They make their money by selling you investments, which means that they don't have to nickel and dime you on property management.
There you go.
All right. So a little bit more.
Yeah. Our leasing team continues to set records. We've rented over 860 homes and moved in those homes through July of this year. We'll set a new world record this year when I'm, at the end of the year, when I share those numbers with you. We're doing that while still challenging ourselves to get longer term leases. So our average duration of initial lease is about 27 months. That's been really consistent over the quarters. A huge credit to our leasing team and a huge value for you to drive higher returns on investment. When I say leasing, we sort of separate between leasing and our regular property management team. So I wanted to give each of those teams just an incredible amount of love and thank you, because our property management team is responsible for the relationship with the resident, the long-term relationship with the resident. And the best way to see that metric working in your favor is how many leases are re-signed. And we re-sign over 70% of the leases that come up. And this is after they signed a long-term lease with us initially. Mm-hmm. So we've re-signed almost 1,000 new leases through July. Again, another JWB world record will be accomplished by our property management team while keeping that eviction percentage, low. Evictions, obviously we want to avoid those. Those are not a fun time for any client. The longer you hold on to real estate, eventually you will have one. And our charge is to, keep that number as low as possible. And we're really happy with under 0.3% of an eviction percentage per month.
And these numbers, to me, average duration of lease, number of leases re-signed, to me as an investor means overperforming on my cash flow projections, right? Like it is the less turns that I have, the better that this investment is going to do over time. And I'm happy, and you guys get to overpromise, underdeliver, right?
There we go.
All right. Bring us home.
Yeah. So guys, I think this is a great time for you to be adding properties to your portfolio for all the reasons that we just talked about there. Number one would be the team performance. But if you're looking for something that represents a little bit of under promise and over deliver, like all great investors do, this effect of downtown, I think represents the greatest opportunity for us to under promise and over deliver for your evaluations over the long haul here in Jacksonville. So I think this is a wonderful time for you to think about where your money may be currently. It may be way over dependent in the stock market. And I think there's a lot of cause of concern for what is going on in the stock market as I think about the next year. Why not take that and reallocate some of that into growing your portfolio with JWB? I think you're going to be really happy, not just for the returns that we deliver on paper for you, but the under promise and over deliver opportunity that we see when you sprinkle in a little bit of downtown on there. So folks ask, what's the general investment criteria right now? So the minimum investment per asset will be about $75,000, give or take. That includes your down payment, closing costs, and property reserves. You can expect a return on investment of 10% or so, potentially slightly higher. Your interest rates will be right around 6% for JWB clients. So we've been able to keep your interest rates lower than what you're hearing or reading about out there because of our relationship with you and with our lenders. So about 6% rates help deliver positive cash flow for you. And we also have multi-purchase incentives. So for clients that purchase 3 properties at one time or more, you actually have quite a large incentive. You save $5,000 on every property. Worked with a client not too long ago, a few weeks ago, purchased 7 properties, saved $35,000 in closing costs received $5,000 off on each of those properties. So great time for you to think about where your money currently is. Think about repositioning it here to your Jacksonville portfolio, and a lot of incentives for you to do that as well.
And the best place to do that?
If you're a current client, go and just reach out to your portfolio manager and let them know that you're interested, and we can set up a phone call. If you're not a client yet, go to chatwithjwb.com and we'll set up a phone call and start to build your portfolio for you.
Got it. So GC, what I basically heard from you, we got a bunch of questions, but we've already gone over. So what we're going to do is, I did this last week. We print out these questions, we show up to Thursday's show, and we answer these questions. So if your name is in the Q&A, we can email it to you afterwards. If not, make sure that you let us know who's asking what, because we can get you a copy of this stuff.
Mm-hmm.
So we're going to jam through those on Thursday. So we hope that you join us there at 12:30. Same link that you just registered on, right?
Mm-hmm.
Should show up. What I'm hearing from you is a market that has the signals of a appreciating market, right? Like it seems to be that between what is already happening right now, the months of inventory, the supply and demand dynamics, we are at equal or above historical home price appreciation is what we can kind of expect. There's also a looming opportunity here that at some point, Jacksonville downtown is going to become real to the rest of the world, not just the sharps that are investing in it right now, but it is going to continue to happen. And as soon as that happens, that appreciation curve is going to increase. And therefore, it's a really, really good time to kind of get in before the stock blows up.
I think so. I really think there's an urgency here, and it's impossible to pinpoint exactly when that moment of downtown coming online is, and the rents are going to go up and the home prices are going to go up. It's impossible to say that, but it's imminent. And when I think about the alternative of where you're placing your money right now, I don't really like a lot of the other options as well. And bonds are not going to get you to your financial goals, long term, even though bonds are higher today than they were a year ago and 2 years ago. I got it, but it's still not going to get you to your long-term financial goals. Stock market doesn't do well in times of pullback in the economy, recession, whatever you want to call it. I mean, PE ratios in the stock market, price to earning ratios, are way high, and tech stocks are driving a lot of the increased value in the S&P 500 and other indexes as well. So I just think there's a lot of volatility in other places you're putting your money. When you come to a JWB investment portfolio here in Jacksonville, you're doing it because of risk mitigation and higher returns. And even if I'm off by 6 months or a year or 2 years or 3 years on the downtown effect, you still have a really high floor. You still have high consistency of asset and consistency of returns, and it still wins versus your other alternatives. So I look at this as it beats the alternatives, and it has significant upside as downtown comes online. And I think it's going to happen soon. So I would urge you to take advantage of this. I think this is a really great opportunity for you to build your portfolio. And I look forward to doing this show for 10, 20 more years and coming back 10 years from now and talking about this conversation that we had and where we urged people to get in now and how well you did, because I had similar conversations in the past for different reasons.
Yeah.
And I urged people to get in at certain times, and those people have done quite well. So I hope you join that group of those successful investors and reach out to us to add to your portfolio.
And again, you go to chat with JWB. The first conversation is literally going to say it's going to help you locate more assets than you thought you had in order to invest in real estate, and also show you that, the projection for where your money is right now and how it's performing versus how it can do in real estate right now. So I think it's just a useful call. Get that thing rolling. Go to chatwithjwb.com. And if you want your questions answered on Thursday, come to the show Thursday. We're a little bit more goofy when we're on the show. We take this one seriously because it's the big quarterly update and all this whiz bang thing. We have a lot more fun on our regular occurrences here, Tuesdays and Thursdays. Would love to have you follow along on the podcast, on the YouTube channel, however you consume it. Go to nyais.com and you can find anything that you need there. Any final words, GC?
I wanted to say thank you to you all spending time with us today, and especially those who asked the questions. I wanted to let you know that we'll be following up with you individually afterwards, as we didn't have time to address the questions here. So you're going to get an individual answer, and as well, we'll share the answers with everybody for our call on Thursday as well. So
it's going to be a great call on Thursday.
I think so, man.
Questions. Yeah.
I think so. We've got some awesome ones. So thank you guys. Thanks for your trust. Thanks for being here. Thanks for making this so much fun for Pablo and I. And I'm excited about the opportunity to serve you for many, many years in the future.
Never take it for granted that you just took an hour and changed the middle of the work week. We appreciate you. We hope that you join us. But if you're going to join us on Tuesdays and Thursdays, there's one thing you got to do, right? You see,
Don't be average.